Have you ever wondered why a country would create a tax system that seems to push its wealthiest citizens away? It's a high-stakes game of economic chess, where one wrong move can send billions of dollars fleeing across the border. Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we re-unpacking one of the most controversial economic experiments in modern history, France's wealth tax. We'll explore why this policy was created, how it drove a generation of entrepreneurs and celebrities to pack their bags, and what lessons it offers for governments worldwide. Taxation systems are more than just a way for governments to raise money. They are powerful tools that shape economies and influence human behavior. The way a country taxes its citizens and businesses can determine where capital flows, where companies are headquartered, and where individuals choose to build their lives. In this globalized world, nations are in constant competition, and high or unpredictable taxes can be a major deterrent for investment. Conversely, countries with lower, more stable tax regimes often become magnets for global wealth and talent. France serves as a compelling case study in this global tax competition. For decades, it has been known for its high taxes, particularly its policies targeting the wealthy. The most famous of these was its wealth tax, which led to a well-documented phenomenon of wealth flight. This exodus of high-net-worth individuals makes France the perfect example to understand the delicate balance between social fairness and economic competitiveness, and how tax policy can have profound, often unintended, consequences on a nation's prosperity. The story of France's wealth tax begins in 1982 with the introduction of the asterisk, Impôt de solidarité sur la fortune asterisk, ISF, or the solidarity tax on wealth. Created under President François Mitterrand's socialist government, the ISF was designed with a clear social mission to redistribute wealth from the richest citizens to fund public services and reduce inequality. The tax targeted an individual's entire net worth, including everything from real estate and stocks to jewelry and yachts. For years, the ISF remained a cornerstone of French fiscal policy, but it was also a source of intense debate. Critics argued that it was economically damaging, discouraging investment, and driving capital out of the country. In response to these concerns, President Emmanuel Macron's government made a significant change in 2018. The ISF was replaced by the asterisk, Impôt sur la fortune immobilière, IFI, or the tax on real estate wealth. This new tax narrowed the focus exclusively to real estate assets, exempting financial investments like stocks and bonds. The government's rationale was to encourage the wealthy to invest their money in French businesses and the broader economy, rather than punishing them for it. Throughout its history, the wealth tax has been a powerful political symbol. Successive governments have used it to signal a commitment to fairness and solidarity, a message that has always resonated strongly with the French public. However, many economists and business leaders saw it as a policy driven more by political symbolism than sound economic principles, arguing that its negative impact on the economy far outweighed the revenue it generated. So who is affected by France's modern wealth tax, the IFI? The tax applies to any individual whose net real estate assets exceed a threshold of 1.3 million euros. This might sound like a tax exclusively for billionaires, but in reality, it affects a much broader group. In expensive urban centers like Paris, where property values are sky-high, many upper-middle-class families, professionals, and retirees can easily find themselves crossing this threshold, especially if they own their family home and perhaps a small vacation property. The tax is calculated on a progressive scale, with rates ranging from 0.5% on assets just above the threshold to 1.5% for the highest brackets. While these percentages might seem small, it's crucial to remember that this is an annual tax levied on top of all other taxes, including income tax, Social Security contributions, and local property taxes, * taxfoncier. For a family with real estate valued at 5 million euros, the annual IFI bill could amount to tens of thousands of euros. Over many years, this recurring charge becomes a significant financial burden, essentially acting as a penalty for holding on to valuable property. This compounding effect can drain wealth over time, particularly for long-term property owners whose assets have appreciated but whose liquid income hasn't kept pace. The impact of France's wealth tax on its high net worth population has been dramatic and widely publicized. The policy triggered a significant wealth flight, with many of France's most successful and visible. Citizens choosing to relocate to countries with more favorable tax environments. The case studies are numerous and well known. Perhaps the most famous example is the actor Gerard Depardieu, who publicly renounced his French citizenship in 2012 to protest high taxes and took up residency in Belgium before becoming a Russian citizen. But Depardieu was far from alone. Prominent business leaders, entrepreneurs, and heirs to major fortunes also made the move. The founder of the electrical equipment giant Schneider Electric and the Wertheimer brothers, who own Chanel, are among the many who have relocated their personal and financial affairs outside of France. Popular destinations for these tax exiles have included neighboring countries like Belgium, Switzerland, the United Kingdom, and the tiny Principality of Monaco, all of which offer more attractive tax regimes for the wealthy. This migration wasn't just about individuals moving. In many cases, entire businesses and family fortunes were restructured to reduce their exposure to the French tax system. Beyond the purely financial calculations, there was a powerful psychological factor at play. Many wealthy individuals felt that the wealth tax unfairly targeted them, punishing their success and portraying them as a problem to be solved rather than assets to the nation. This perception of being scapegoated for broader economic issues created a sense of alienation and resentment, making the decision to leave not just a smart financial move, but an emotional one as well. From a purely budgetary perspective, the wealth tax did bring in revenue. Over the years, the ISF and later the IFI collected billions of euros for the French government, which were used to fund social programs and public services. In the short term, this provided a tangible benefit to the state's coffers. However, many economists argue that these short-term gains were dwarfed by the long-term economic losses. The capital flight prompted by the tax had a chilling effect on the French economy. When wealthy individuals leave, they take more than just their tax payments with them. They take their investments, their entrepreneurial spirit, and their consumption. The exodus resulted in reduced private investment in French startups and established companies, a less dynamic business environment, and ultimately, the loss of the very taxpayers the system was designed to tax. The revenue gained from the wealth tax was often more than offset by the loss of income tax, VAT, and corporate taxes that these individuals and their businesses would have otherwise paid. This led to widespread criticism from international observers and economists, who often described France's tax policies as short-sighted. The wealth tax was seen as a classic example of a policy that was effective at signaling a commitment to social justice. but was ultimately detrimental to the country's economic competitiveness. It appeared to prioritize the political goal of redistribution over the economic goal of fostering growth and prosperity. France's approach to taxing wealth is a significant outlier among major developed economies. Countries like the United States, the United Kingdom, and Australia do not impose a direct annual tax on an individual's total net worth. Instead, they rely on other mechanisms to tax wealth, such as capital gains taxes, which are levied when an asset is sold at a profit, inheritance or estate taxes, which apply when wealth is transferred to the next generation, and annual property taxes based on assessed real estate values. These systems are generally considered more predictable and less discouraging for long-term investment. As they typically tax wealth at moments of transaction or transfer rather than simply for holding it, France's decision to directly tax the net wealth of its residents, even in its narrowed real estate-focused form, is unusual and often perceived as punitive. This has made the country less attractive for high-net-worth individuals and international investors when compared to its neighbors. The stark contrast in tax policy highlights why so many chose to move to places like Switzerland or the UK, where their capital could grow without the constant erosion of an annual wealth tax. The lesson for policymakers in other countries is clear. Taxation must be designed to achieve fairness without inadvertently driving away the high-value residents and investors who are crucial for economic dynamism. Within France, the wealth tax remains a deeply divisive issue that cuts to the core of the nation's identity and values. For a large portion of the French population, the tax is seen as a fundamental pillar of social justice. The principle that the wealthiest members of society should contribute a larger share to the common good. To pay their share is a powerful and popular idea. From this perspective, the wealth tax is an essential tool for ensuring fairness and funding the country's robust social safety net. On the other side of the debate are those who argue that the tax, in any form, undermines economic growth. They contend that by discouraging investment and driving talent out of the country, the policy ultimately hurts everyone, not just the rich. This viewpoint is championed by business groups and right-of-center political parties, who criticize the tax for damaging France's international competitiveness and stifling entrepreneurship. The political battle lines are clearly drawn. Left-wing parties have consistently defended the wealth tax as a crucial instrument of redistribution, and have called for its re-expansion to cover all assets, not just real estate. Conversely, right-wing parties have long advocated for its complete abolition, arguing that it is an ideological relic that has no place in a modern competitive economy. This debate is far from over. The future of wealth taxation in France will depend on how the country chooses to balance the deeply held value of social solidarity with the pragmatic need to compete in a globalized world. France's long and complicated history with the wealth tax offers a powerful lesson in economic policy. It demonstrates how a measure designed with the best of intentions to promote fairness and fund public services can have unintended and damaging consequences when it pushes away the very people it aims to tax. The exodus of wealth and talent from France serves as a stark reminder that in a globalized economy, capital is mobile and will flow to where it is treated best. The broader lesson here extends far beyond France's borders. It's a challenge that every government in the world faces: how to design a tax system that is both fair and efficient. Finding the right balance between ensuring social equity through taxation and maintaining an attractive environment. For investment and wealth creation, is one of the most difficult tasks for any policymaker. It's a tightrope walk with enormous consequences for a nation's prosperity. Now, we want to hear from you. What do you think is the right approach? Should governments prioritize equality by taxing the wealthy more heavily, even if it risks driving them away? Or should the focus be on competitiveness, creating a low-tax environment to attract and retain wealth? Let us know your thoughts in the comments below.